The question. Clients frequently ask me the following question: if I'm making a profit, why do I never have any money in the bank? The short answer is that profit and cash flow are very different things. This is important to remember. Profits are not necessarily money in the bank. The timing of liability payments, loan repayments, and the time it takes for your customers to actually pay, among other factors, affect cash flow, which is equal to the actual money flowing into and out of your business at any given time. The issue is that, for the majority of businesses, cash flow is behind profit. Adequate, positive cash flow is essential for the survival of any business. The two primary causes of failure are: 1. Poor leadership. 2. Inadequate cash flow or high cash use. So what are the contributing factors to mismanaging cash? Bad record keeping, shoeboxing, not asking for payment, invoicing, driving blind, budgeting, neglecting the bird in the hand, upselling, not sealing the hole for the plug, breaking even, mixing business with pleasure, separating spending, spending the inheritance, pilfering, not preparing monthly financial statements. Factor 1. Keeping all of your receipts in an equivalent of a shoebox, shoeboxing, especially as they mount up, is a pain to keep track of, no question about it. Money leaves, but you have no real-time tracking to know for sure where it's gone. It turns into a gut feeling. If you do not consistently keep track of your expenses and income, you will never be able to run a profitable business. If time is what you're lacking, then invest in a good bookkeeper who will keep your data entry up to date, but get it done. One of the most important things that small business owners neglect is bookkeeping, and cash flow suffers because of this. Factor 2. Not asking for payment, invoicing. Having a mere invoice on paper is worthless until the money actually appears in your bank. You know what's even worse than this? Failing to invoice customers for your service or products. Factor 3. Driving blind, budgeting. I know that business owners don't consciously plan to fail, but by failing to plan, this is effectively what they are doing. A simple cash budget that you actually monitor along the way will help keep you on track and highlight when your financial situation starts to go out of control. Factor 4. Neglecting the bird in the hand. Upselling. Selling more services to your existing customers is the easiest way of increasing revenue. After all, they already trust you, so they will be more likely to buy from you than anyone else if you offer them something new, more. Factor 5. Not evaluating revenues and expenses. Although it is jargon, the idea of a break-even point is actually quite straightforward. It's just the amount of income you need to earn in order to cover all of your expenses. If you know your break-even point, you'll be able to get into the good habit of managing revenues, expenses, profits, and product mix. Factor 6. Mixing business with pleasure, separating spending. You might think that using your personal bank accounts for business expenses and vice versa isn't a big deal. But take a moment to consider the indirect effect this has on your cash flow. Firstly, if you mix your personal and business expenses up, how are you ever going to keep track of what money is yours and what money belongs to the business? Factor 7. Spending the inheritance, stealing, from the business. Taking money out of the business for yourself before paying liabilities will send you spiraling into a financial black hole before you know it. So if it's not your money, then don't use it. Physically put it aside in a do not touch until due bucket and pay your obligations on time. Not ahead of time, but on time. Factor 8. Not preparing financial statements and paying special attention to the income statement. While profits and cash flows are two different animals, profit is a major contributor to adequate cash. Summary 1. Records. Keep your records up to date. 2. Invoicing. Invoice clients regularly and consistently. 3. Budgeting. Drive your business forward with a map to keep you honest. 4. Customers. Treat your customers with respect and offer them more on a regular basis. 5. Break even. Know your break-even point and other key indicators. 6. Mixed spending. Use your business money to pay business expenses only, not personal expenses, or vice versa for that matter. 7. Put liabilities aside regularly and pay them when due. 8. Prepare financial statements.